Why do successful investors seem certain that Bitcoin's famous price cycles are about to change forever? For the past decade, Bitcoin has followed a predictable 4-year cycle defined by dramatic rises and equally dramatic falls. But something unprecedented is happening. On the TFTC podcast, I sat down with Matthew Majinskis, a veteran Bitcoin market analyst known for accurately predicting major market shifts through his unique monetary base analysis. His research has consistently highlighted crucial patterns in global currency markets and their relationship to Bitcoin. Today, we'll explore 3 critical developments: the breakdown of Bitcoin's traditional 4-year cycle, how institutional players are fundamentally altering market dynamics, and what new patterns are emerging to replace the old ones. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. In this first clip, I explain why recent changes in Bitcoin market structure suggest we're entering uncharted territory, particularly with the possibility of a U.S. strategic reserve. I mean, it's been a bit tongue-in-cheek, but I've been putting the super cycle meme back out there. Suzu was a cycle too early. I don't think if it all depends on how things materialize, particularly here in the United States, I think, in the next year. Like if rumors behind the scenes here is that the Trump administration is very adamant about following up on the promise of a Bitcoin strategic reserve. And some people are confident that whether it's an executive order or a bill making its way through the House and the Senate and to Trump's desk is in the realm of possibility of happening within the first 100 days. Here's what's significant about this conversation. Historically, Bitcoin's price has followed a predictable pattern tied to the halving cycle, a technical event that occurs every 4 years. This pattern typically resulted in massive price increases followed by equally dramatic 60 to 80% drops. However, what we're seeing now suggests a fundamental shift. The potential for U.S. government involvement through a strategic Bitcoin reserve represents something entirely new. This isn't just another institution buying Bitcoin. It's the world's most powerful government potentially recognizing Bitcoin as a strategic asset. The implications here go beyond simple price action. Consider what this means for global monetary policy. When the U.S. government starts treating Bitcoin as a strategic asset, other nations will be forced to reevaluate their positions. This could trigger a competitive dynamic among nations similar to the space race, but instead of competing for technological superiority, they're competing for Bitcoin accumulation. This kind of adoption could permanently alter how Bitcoin's price behaves by introducing a type of demand we've never seen before. As we look deeper into these changes, it's important to understand how this shift mirrors another technological revolution. Let's examine how this institutional evolution compares to the internet's adoption in the 1990s. Like the comment you just made, I think it's becoming abundantly clear to everybody, right, this thing is not dying. Maybe I was wrong.
Lindy effect, right?
Like Lindy's kicking in. Obviously, we've talked about not us specifically, but it's been talked about in the industry. Like it's tracking this internet adoption cycle that happened. Broadband internet hit the tape in the 90s, and that was an S-curve adoption. And when it comes to like Bitcoin price cycles, like it could be wrong, but it just feels like, I don't know, I just had this intuition that we are approaching, we had the original monetization and the lull, I would argue, between 2013 and 2022, and now 16 years in, Bitcoin hasn't died. We've had 4 of these cycles. The parallels between Bitcoin's adoption and the internet's growth in the 1990s are striking and help explain the changing market dynamics we're seeing. Just as the internet evolved from a niche technology to global infrastructure, Bitcoin is transitioning from a retail-driven speculation vehicle to a serious institutional asset. This transition is crucial because institutional investors operate on completely different timeframes and with different objectives than retail investors. They're not looking to make quick profits. They're building long-term strategic positions. What's particularly fascinating is how this shift is happening across multiple sectors simultaneously, from public companies to financial institutions to potentially governments. The network effects of this adoption create a feedback loop. As more institutions enter the space, it becomes safer for others to follow, which in turn attracts more institutional interest. This compounding institutional adoption is one of the primary reasons why the traditional 4-year cycle might be breaking down. We're no longer just dealing with retail investor psychology and speculation. We're seeing the emergence of sophisticated financial structures built around Bitcoin. This brings us to a fascinating development in how these institutions are actually using Bitcoin in the real world. Let's look at how new financial products are changing the game. And I think that's going to be a big trend. This cycle is Bitcoin beginning to fit into credit markets because all these credit investors are looking for better return.
I saw that.
And you're pulling Bitcoin off the market and holding in these long duration credit products, which just creates like a higher a higher floor, I imagine, or a sturdier base. A new pattern is emerging in the market, and it's fundamentally different from what we've seen before. Companies are now using Bitcoin as collateral in traditional financial deals, particularly in real estate. At 1031, we're seeing firsthand how these new financial products are creating what we call locked up supply, Bitcoin that can't be easily sold because it's tied up in long-term financial contracts. This innovation is significant because it reduces the amount of Bitcoin available for trading, potentially dampening the dramatic price swings we've seen in previous cycles. But the implications go even deeper. These financial products are creating new linkages between Bitcoin and traditional assets, effectively embedding Bitcoin into the broader financial system. When Bitcoin becomes collateral for real-world assets, it creates a form of price stability mechanism. Neither the borrower nor the lender wants to see dramatic price swings, which incentivizes longer-term holding behavior. This represents a maturation of the Bitcoin market that simply didn't exist in previous cycles. Now let's examine how one of Bitcoin's largest corporate holders is using financial engineering to create even more sophisticated holding structures.
Yeah, I mean, it's literally the exact same principle that we were talking about when we were talking about what the Treasury could do, right? Right. I mean, whether there's upside appreciation for bondholders or not, that's a whole different thing, whole different question, I guess. But for Treasury bondholders, but yeah, if you're talking about for private credit and you're talking about financing some what might be some sort of sketchy or kind of risky deal, not sure where rents are going to go, you're not sure where unemployment's going to go, you're not sure where interest rates are going to go, and you're able to secure that with a very sound asset that regardless, the fund, the investment vehicle is going to need to keep on their balance sheet. And the loan that is drawn on that property, a portion of that must go into Bitcoin.
This evolution in how Bitcoin is being used in financial markets represents a maturation of the asset class. When institutions like MicroStrategy structure long-term Bitcoin holdings through convertible notes, they're essentially creating price stability mechanisms. These financial instruments lock up Bitcoin for years at a time, reducing selling pressure during market downturns. What's particularly innovative about this approach is how it uses traditional financial markets to support Bitcoin accumulation while managing risk. These convertible notes allow companies to borrow at better rates than they could otherwise, using the potential upside of Bitcoin as a sweetener for investors. This is fundamentally different from the past when most Bitcoin was held by individual investors who could easily sell during panic moments. The combination of institutional holding strategies, collateralized lending, and potential government involvement is creating a new market pattern, one characterized by higher price floors and potentially less dramatic drawdowns. This isn't just speculation. We're seeing these changes play out in real time through actual market mechanisms and financial products. The sophistication of these financial structures suggests that Bitcoin is entering a new phase of market maturity, one where traditional market cycles may become less relevant as institutional mechanisms increasingly dominate price discovery. And if you found this milestone analysis fascinating, you'll want to watch our breakdown of how Bitcoin is silently overtaking central bank gold reserves. The flip from old money to new money is happening right before our eyes. Click the video on your screen now. Stay humble. Stack sats.